My name is Garrett Van Ostren, and I'm a financial advisor with Van Ostren Wealth Management. The benefit of a stronger currency is that imports become cheaper for domestic consumers. If you're a US consumer buying in Europe and the exchange rate goes from 1-to-1 to 2-to-1, then a €100 product will go from $100 to $50. But the detriment of a stronger currency is that your companies become less competitive. For example, if you're a US company selling in Europe for €100 or $100 and the dollar strengthens, then the same sale now only makes you $50. And if your product is built in the US, then it still costs the same amount of dollars to build, but now only sells for half the amount of dollars and has now become unprofitable. Exchange rates change based on the supply and demand of those currencies. The dollar may strengthen because international investors are exchanging their currencies for US dollars in order to buy American stocks, bonds, or products. This is a positive in the sense that American stock prices increase and Americans can get loans for lower interest rates. On the flip side, however, American products become more expensive to international consumers and less American products get bought as a result. It is this dynamic of the strong dollar that has helped fuel the US trade deficit. And now that we've laid the foundation for how exchange rates work, it's my intention in future videos to explain why trade tensions are so extreme. Because tariffs are not the beginning of these global trade tensions, but rather an escalation in a much longer story.